Welcome to the deep dive. Today, we're cutting through some real complexity to understand something, well, absolutely vital. It really underpins trust in the entire financial world. Imagine getting a report card, but not just any report card. This one's issued by an independent expert eye that tells you if a company's financial story, truly holds up. Okay, let's unpack this. Today, we're diving deep into the often misunderstood world of audit opinions. Now, you might already know that companies hire independent auditors to review their financial statements, right? But the real magic, the true insight, lies in what kind of opinion that auditor actually issues. Think of it as the ultimate seal of approval, maybe. Or perhaps a significant warning sign about a company's financial health. And it's critical because so many people, individual investors like you, massive banks, potential business partners, even employees, they rely on these statements to make incredibly important decisions. Honestly, without this independent assessment, the financial landscape would be, well, kind of like the Wild West, just full of uncertainty and maybe even deception.
Yeah, and what's fascinating here is that audit opinions are far more than just a simple stamp of approval. It's not a rubber stamp exercise at all. They are actually a deeply nuanced, precisely articulated communication. It's from the auditor straight to the public. It's their professional judgment distilled into this concise yet really powerful statement, meticulously designed to tell you exactly how reliable, how trustworthy a company's financial narrative truly is. So our mission today is to thoroughly break down what these different types of opinions mean, why they matter so profoundly to you, whether you're an investor trying to figure out where to put your money, or maybe a business partner considering a new venture, or honestly, just someone trying to understand the financial news headlines. And we need to understand what the various signals from these opinions really convey about a company's financial health and, frankly, its integrity. We'll explore the subtle distinctions and the significant implications of each type. We want to make sure you grasp the full spectrum of what an audit opinion can tell you, and maybe more importantly, how you can use that knowledge.
And to help us navigate this pretty intricate landscape, we're working with some carefully curated excerpts that really clarify the precise process of forming an audit opinion and the different types you might encounter. We've distilled these complex ideas for, well, absolute clarity, ensuring that every concept is explained in detail and hopefully in a way that's easy to grasp. Our goal is really to empower you with the knowledge to read an auditor's report with true understanding and, be able to pull out those critical insights for yourself. So to truly grasp what an audit opinion means, we have to start right at the beginning. Understanding the core mission of the auditor themselves. How do they even begin to form this incredibly weighty opinion?
Right, that's the foundation. The fundamental role, the core job of an auditor is to form an opinion on whether financial statements are presented fairly in all material respects. And this is key, in accordance with a specific financial reporting framework. That phrase, presented fairly, is critical. It implies that the financial statements, as a whole, accurately reflect the economic reality of the business. It doesn't mean they're perfect down to the last cent.
Okay, so not perfection, but a fair picture.
Exactly. It's about providing a reasonable, unbiased, and transparent view of the company's financial situation. And that second part, in all material respects, is just as vital. It means the auditor is focused on information that's significant enough that its omission or misstatement could genuinely influence the economic decisions of someone relying on those statements.
Like an investor deciding whether to buy stock or a bank deciding whether to lend money.
Precisely. They aren't looking for every single tiny typo or clerical error. They're hunting for the errors that could genuinely mislead that investor or that lender. And this fair presentation, even with the judgment and estimation involved, that's what builds trust. It builds reliability in the financial information for anyone who uses it, individuals, big institutions, everyone. It's about ensuring the information is credible enough to act on, knowing it presents a true economic picture.
Okay, so it's about a reasonable, unbiased view that provides confidence rather than chasing absolute down-to-the-penny perfection. That makes sense. But how does an auditor actually arrive at this crucial, comprehensive opinion? It sounds like a massive undertaking, especially for, say, a huge multi-billion-dollar company. What are the absolute foundational elements, the main pillars they have to consider?
You're right. It is a massive undertaking. And it really boils down to three main pillars that guide pretty much every aspect of the auditor's work. These are the foundations for making that well-informed, independent judgment. First, pillar number one, the auditor must ensure they've obtained sufficient appropriate audit evidence. Now let's break that down, because this is where a huge chunk of the audit effort goes. Sufficient refers to the quantity of evidence. Did they collect enough information, enough tests, enough confirmations?
So, how much evidence is enough? Is there a set amount?
Well, no, it isn't a fixed number. It's a professional judgment call based on the risk involved. For example, if a company reports, say, a massive inventory balance, the auditor needs to perform enough tests to feel confident about that number. That might mean observing inventory counts at multiple warehouses, maybe reviewing their inventory management systems, confirming ownership if it's stored somewhere else. It's about building a body of evidence that robustly supports their opinion.
Okay, quantity. Got it. What about appropriate?
Appropriate refers to the quality of the evidence. Is it relevant to what they're testing? And importantly, is it reliable? For instance, getting a bank confirmation sent directly from the bank to the auditor is generally considered highly reliable evidence for cash balances. Much more reliable than just looking at the company's own internal bank statement printout, which, could potentially be altered.
Right, directly from the source is better.
Exactly. And the whole process of gathering this evidence, both sufficient and appropriate, is guided by generally accepted auditing standards, or GAs. Think of GAs as the comprehensive how-to guide for auditors. It lays out the detailed framework, the principles for conducting an audit planning, assessing risks, designing tests, gathering evidence, evaluating it, all of it. For example, GAA specifically talks about the auditor's responsibilities for observing physical inventory counts. That's a concrete way to gather quality evidence about whether assets actually exist and what condition they're in.
So GAS is the rule book for how they audit.
Precisely. And a big challenge for auditors is often figuring out what truly counts as sufficient evidence, especially with complex global companies, or sometimes when management tries to limit their access. Okay, pillar number 2. The auditor must assess the materiality of uncorrected misstatements.
Uncorrected misstatements, so errors they found that the company hasn't fixed.
Exactly. Look, after all the testing, auditors almost always find some errors or misstatements. Could be innocent mistakes, could be something else. The key question is whether these errors, either individually or when you add them all up, are material. A misstatement is material if it could reasonably be expected to influence the economic decisions of users, those investors, lenders we talked about, who are relying on the financial statements.
So it's about impact again. Does it change the story significantly?
Precisely. And it's not just a simple percentage calculation, though that's part of it. Auditors use a mix of quantitative, dollar amounts and qualitative factors. For example, say a huge company with billions in revenue misstates an expense by like $10,000. Quantitatively, that's tiny, probably immaterial. It won't change anyone's decision.
Right, a drop in the ocean.
But what if that $10,000 misstatement is just enough to change a reported loss into a profit? Or maybe it causes the company to violate a loan agreement, a debt covenant.
Then even a small amount matters a lot.
Exactly.
Yeah.
In those qualitative scenarios, even a small dollar amount can become material because it fundamentally changes the perception of the company's performance or its stability. Auditors have to use significant professional judgment here, and there could be intense discussions with management about this threshold. It directly impacts whether the statements get that fairly presented label.
Okay, that makes sense. Evidence, materiality. What's the third pillar?
Pillar number 3. The auditor evaluates whether the financial statements are prepared, in all material respects, in accordance with the requirements of the applicable financial reporting framework. In the U.S., this usually means Generally Accepted Accounting Principles, or GAAP. For global companies, it might be International Financial Reporting Standards, IFRS.
So this is about following the actual accounting rules, the what to evaluate against guide, you called it.
Exactly. This pillar is all about compliance with the established rules. GAAP, or IFRS, dictates precisely how transactions should be recorded, how assets and liabilities should be valued, when revenue can be recognized, what information must be disclosed in the notes. For instance, GAAP has really strict rules for revenue recognition. You generally have to earn it and be reasonably sure you'll collect it before you can book it. So an auditor would check to make sure the company hasn't, say, prematurely recognized revenue from sales that haven't actually happened yet. That would be a misapplication of the framework.
And following these rules makes companies comparable.
Yes, that's a huge benefit. This pillar ensures consistency and comparability across different companies' financial statements, allowing you, the user, to make more meaningful apples-to-apples comparisons.
Okay, those 3 pillars, sufficient appropriate evidence based on GS, checking the materiality of any mistakes, and ensuring compliance with the accounting framework like GAAP, they truly form the backbone. It's clear they're not just checking if numbers add up, but if the whole story is true and fair. So when we talk about auditors scrutinizing these financial statements, what exactly are we referring to? It sounds like it's more than just the bottom line profit number, right?
Oh, absolutely. Way more. When auditors refer to financial statements, they mean a complete set of general-purpose financial statements. And crucially, this includes all the accompanying disclosures, often called the notes to the financial statements. As you probably know, the specific form and content are dictated by that applicable framework, like U.S. GAAP. And under U.S. GAAP, a complete set has 5 key components. Understanding how they link together is really vital for you, the listener, to appreciate the depth of an audit. First, you've got the balance sheet. Think of it like a financial snapshot at a specific moment in time, end of the quarter, end of the year. Assets, liabilities, equity. Right. What you own, what you owe, what's left over for the owners. Exactly. It follows that fundamental equation. Assets equal liabilities plus equity. For the auditor, it's about verifying those balances are accurate. Second, the statement of income, often called the P&L, profit and loss, or statement of comprehensive income. This shows performance over a period, a quarter or a year. Summarizes revenues earned, expenses incurred, gets you to net profit or loss.
And the auditor's checking revenue is recorded right. Expenses match up.
Yep, matching principle, revenue recognition, all those core concepts. Third is the statement of changes in equity. This one tracks how the owners stake their equity change during the period. It shows things like new investments, dividends paid out, and critically, how the net income or loss from the income statement flows in.
So it connects the income statement back to the balance sheet.
Precisely. Shows the flow of value to the owners. Fourth, and incredibly important, is the cash flow statement. This tells you exactly where the company's cash came from and where it went during the period. It breaks cash flows down into operating, investing, and financing activities. Operating is day-to-day business. Investing is buying or selling long-term assets. Financing is borrowing money, issuing stock, repaying debt.
This one seems super important because profit doesn't always mean cash, right?
Absolutely critical. You can be profitable on paper, but run out of cash. This statement gives a much clearer picture of liquidity and solvency. Auditors pay close attention here because cash flows are generally harder to manipulate than accrual-based accounting figures. And finally, but maybe the most crucial piece for understanding, are the accompanying disclosures or the notes.
Ah, the infamous fine print.
People call it that, but it's anything but trivial. These notes provide critical details, explanations, context for all the numbers in the main statements. They include info on the accounting policies used, details on specific accounts like debt terms or lease obligations, potential problems like pending lawsuits, contingencies, deals with related parties, other significant events.
So this is where a lot of the important context lives.
Absolutely fundamental. These disclosures often contain vital qualitative information that explains the why behind the numbers and reveals key management judgments or risks. An audit opinion doesn't just cover the numbers on the face, it covers the completeness and fairness of these disclosures too.
That's a fantastic breakdown. It really hammers home that an auditor isn't just glancing at a P&L, they're examining this whole interconnected financial narrative, from the big summaries down to the nitty-gritty details in the notes. Understanding all these parts is definitely vital for our listeners to grasp the depth here. So given all these statements and all these detailed notes, what specific, almost granular areas does an auditor systematically evaluate when they're forming their opinion? I imagine it's not just a general, looks okay, but a very structured checklist almost.
Oh, it's very structured, precisely. When forming the opinion, the auditor systematically evaluates 8 specific aspects of these financial statements. And these evaluations are all benchmarked against whether the information conforms, in all material respects, to that applicable financial reporting framework, like GAAP. Let's quickly run through them as they really highlight the level of detail. First, they check if the financial statements adequately disclose the significant accounting policies selected and applied. This means, does the company clearly explain how they calculated their numbers? Like, which inventory method, FIFO, LIFO, how do they recognize revenue on long-term projects? Users need this context.
Transparency on the methods, got it.
Second, are the accounting policies selected and applied consistent with the framework and appropriate? So it's not just disclosed, but is it actually allowed under GAAP? And does it make sense for this company in this industry? And are they applying it consistently year over year?
So no weird accounting choices or switching things around without good reason.
Exactly. Consistency is key for comparing performance over time. Third, and this is a big one, they scrutinize the reasonableness of management's accounting estimates and related disclosures. Lots of numbers aren't exact facts, they're estimates.
Like how long a machine will last or how many customers won't pay their bills.
Perfect examples. Useful life of assets, allowance for doubtful accounts, warranty costs. These all involve significant management judgment. often based on assumptions about the future. The auditor isn't saying the estimate is perfect, but is it reasonable given the facts? And crucially, are the disclosures about how these estimates were made and the key assumptions adequate? This is a really common area for potential misstatements.
Because estimates involve judgment, and judgment can be biased or just plain wrong.
Precisely. Fourth, they evaluate if the information presented is relevant, reliable, comparable, and understandable. These are the bedrock qualitative characteristics. Does it matter? Relevant? Can you trust it? Reliable? Can you compare it over time and to other companies? Comparable? Is it presented clearly? Understandable? Fifth, do the statements provide adequate disclosures to understand the effect of material transactions and events? If there was a huge lawsuit, a major acquisition, a natural disaster affecting operations, is the financial impact clearly explained in the notes? Users need to grasp the consequences.
Context for the big stuff. Makes sense.
Sixth is the terminology used, including the title of each financial statement, appropriate. Sounds minor, but using standard terms like balance sheet, statement of income, avoids confusion and helps users navigate. Clarity matters. Seventh, they assess the fair presentation of the overall structure and content. Stepping back, looking at the big picture, does the way everything is organized and presented give a fair, coherent view? Is anything buried or obscure? It's a holistic look. And eighth, maybe the most encompassing, do the financial statements, including disclosures, represent the underlying transactions and events in a manner that achieves fair presentation? This gets to substance over form. Do the numbers and notes truly reflect the economic reality of what happened? Or is it structured just to get a specific accounting result?
Okay, wow. Here's where it gets really interesting because it's so clear the auditor isn't just like ticking boxes on numbers. They're ensuring the entire financial narrative makes sense, is transparent, and truly reflects reality. That's a huge responsibility. Now that we understand the incredibly detailed way an auditor forms an opinion, let's move to section 2. The gold standard, the unmodified, or sometimes called unqualified, opinion. This is the goal, right? The clean bill of health everyone wants to see.
It absolutely is. An unmodified opinion, or same thing, an unqualified opinion, is definitely the most desired outcome for any company going through an audit. When an auditor issues this type of opinion, they're basically stating pretty unequivocally that the financial statements present fairly, in all material respects, the company's financial position, results of operations, and cash flows, all in line with the accounting rules, the applicable framework. In essence, it's the auditor's professional stamp saying, based on our extensive work, the evidence we gathered, our expert judgment, this company's financial story is reliable and free from significant misstatements. It gives investors confidence, banks the green light to lend, partners trust. It speaks volumes.
Okay, so it's the best possible outcome. Now, you mentioned two terms, unmodified and unqualified. Are they interchangeable?
They mean the exact same thing, that clean bill of health. But there's a slight terminology difference based on who the auditor is reporting to, essentially. Unmodified is the term typically used for non-issuers, think private companies. Their audits fall under the AICPA standards. Unqualified is the term used for issuers. These are the public companies, traded on stock exchanges. Their audits are overseen by the PCAOB.
Ah, so public versus private distinction, but the meaning for the user is identical.
Exactly. Different regulators, slightly different words, same positive message. The financial statements as a whole are considered fair and reliable. For you, the listener, just know they both mean good news.
That's a great clarification. So if a company gets this clean bill of health, fantastic. But is that always the entire story from the auditor? Or are there situations where, even with that clean opinion, the auditor needs to add a little extra note, draw attention to something specific, like adding a crucial post-it note without changing the A+ grade itself?
That's a perfect analogy. You're spot on. Yes, absolutely. In certain circumstances, even when the auditor concludes, yep, these are fairly presented, unmodified opinion it is, they might still decide it's necessary to add extra communication to the report. These additions don't change the opinion. It's still unmodified, unqualified, but they highlight something important that users should be aware of. They provide context or emphasize crucial information that's already in the financial statements. For non-issuers, private companies, these come in two main flavors, emphasis of matter paragraphs and other matter paragraphs.
Okay, emphasis of matter. What kind of matter gets emphasized?
An emphasis of matter paragraph is used when there's something already presented or disclosed in the financial statements that the auditor thinks is so fundamental to users' understanding it needs a special spotlight in the report. Think of things like a major uncertainty, maybe a huge lawsuit where the outcome is unknown but could have a massive financial impact, and it's all laid out in the notes. The auditor might add this paragraph to say, hey, pay close attention to Note 15 about this lawsuit.
So pointing to something already there, but saying, this is really important.
Exactly. Another common one is substantial doubt about the company's ability to continue as a going concern, basically. Can it stay in business for the foreseeable future? If there's doubt, and it's disclosed, the auditor will likely emphasize it. Or maybe a big, acceptable change in accounting principles, like switching inventory methods. The statements are still fair under the new method, but the change itself is key for comparing results, so it gets emphasized.
So it's like the auditor saying, this info is in the notes, but seriously, go read it carefully.
Precisely. It guides your attention. Now, the second type for non-issuers is an other matter paragraph. This one is used when there's a matter other than those presented or disclosed in the company's financial statements that is relevant to understanding the audit itself, the auditor's responsibilities, or their report. The info isn't in the company's notes.
Okay, so what kind of external info would that be?
A common example is if the prior year's financial statements, shown for comparison, were audited by a different auditor. The current auditor would add an other matter paragraph to explain that. Or maybe the auditor is reporting on something extra, beyond just the main financial statements, like compliance with specific contract terms. It provides context about the audit scope or circumstances.
Got it. Emphasis of matter points inside the financials, other matter points outside or to the audit process itself. What about public companies?
For issuers, public companies, a similar function is served by explanatory paragraphs. These are used under PCAOB standards for things similar to what emphasis of matter and other matter paragraphs cover for private companies. So, substantial doubt about going concern for a public company. That gets an explanatory paragraph highlighting the disclosure. Other uses include pointing out segment information disclosures, noting a lack of consistency because of an accounting change, or maybe a change in the reporting entity itself.
Okay, so bottom line, whether it's emphasis of matter, other matter, or explanatory, the main opinion is still clean, still unmodified, or unqualified.
That's the key takeaway. The company still gets its clean bill of health. But there's an important asterisk, a signpost from the auditor guiding your attention to something specific you really should understand.
So if you, our listener, see one of these added paragraphs, it's absolutely not a bad sign about the statements themselves. Instead, it's a crucial heads up from the auditor. Something specific needs your attention, or it provides important context about the audit. It's like that footnote on the perfect report card saying, by the way, this A-plus student is switching majors next semester. It's really important info for anyone doing their homework on the company. Okay, we've covered the gold standard, the unmodified opinion, the clean bill, maybe with a helpful explanatory note. But what happens when things aren't so clean? What if the statements do have significant issues or the auditor just couldn't get the evidence they needed? This takes us into Section 3. When things get tricky, modified opinions, these are the red flags, right? But maybe not all red flags mean the same thing.
Indeed. This is where things get more serious, and the auditor's role shifts from providing that clean assurance to signaling a significant problem. An auditor's report has to be modified, changed from that standard unmodified opinion under two primary circumstances. And it's really vital you understand the difference between these two root causes because they signal very different kinds of problems. The first reason for modification is when the auditor concludes, based on their evidence, that the financial statements as a whole are materially misstated. We call this a financial statement issue.
Meaning the company's numbers themselves are wrong.
Essentially, yes. It means there are errors or omissions or misapplications of the accounting rules, like GAAP, within the company's own financial statements. And these problems are significant enough, material enough, to potentially mislead users. For instance, maybe a company intentionally inflated its revenue, or maybe it simply failed to record a massive known liability, like a huge environmental cleanup cost it knows it has to pay. If those amounts are material, then the financial statements themselves are just not presenting a fair picture. The auditor found the problem within the company's reporting.
Okay, so that's a problem with the company's books. What's the second reason?
The second reason is when the auditor is unable to obtain sufficient appropriate audit evidence to conclude that the financial statements as a whole are free from material misstatement. This is what we call an audit issue, or sometimes a scope limitation.
So this means the auditor couldn't do their job properly.
Pretty much. It means they couldn't gather enough reliable information to even form an opinion. Maybe management restricted their access, wouldn't let them see certain records or talk to key people. Or maybe it was due to circumstances beyond anyone's control, like a fire destroying critical accounting records. In this scenario, the auditor isn't necessarily saying the financial statements are wrong. They're saying they cannot confirm that they are not wrong because they couldn't perform the necessary audit procedures. They lack the evidence foundation.
Ah, so they couldn't get the info they needed to make a judgment. This sounds like a problem with the audit process itself.
Exactly. It's an audit issue, not necessarily a proven financial statement issue. But the result for the user is similarly problematic. No assurance can be given because the auditor couldn't finish their work satisfactorily.
This raises a really important question. How do we distinguish between these two root causes, a problem with the statements versus a problem getting evidence? And what kind of red flag does each type wave? Because a modified opinion isn't just one single thing, is it? You mentioned different levels of concern, like a gradient of warning.
You're absolutely right. There are definitely different shades of red, ranging from a specific targeted warning to a complete rejection of the financials, or even an inability to comment at all. There are three distinct types of modified opinions. Each signals a different severity and nature of the problem: the qualified opinion, the adverse opinion, and the disclaimer of opinion. And the key differentiator between them often comes down to this concept of pervasiveness, basically, how widespread or fundamental the problem is. We'll dig into pervasiveness in a moment, but let's define the opinions first. Let's start with the qualified opinion. This is the least severe type of modification. A qualified opinion is issued when the auditor concludes that, quote, except the effects of the matter to which the qualification relates, the financial statements present fairly in all material respects. You get the idea.
Except for, that sounds like a targeted issue.
Exactly. The implication is there's a specific identified problem. It could be a material misstatement in one area, or it could be an inability to get evidence about one specific area, the scope limitation. But crucially, the problem is considered material, but not pervasive.
Not pervasive, meaning it's isolated, contained, it doesn't taint the whole picture.
That's the idea. It doesn't fundamentally distort the overall financial picture.
So it's like our earlier analogy. This car is great except for that one headlight that's out and maybe the radio doesn't work. You know exactly what the issues are. They're significant enough to mention material, but they don't ruin the whole car. You can still generally rely on the rest of it, but you're aware of these specific problems.
That's a perfect analogy for a qualified opinion. It's a specific warning, not a wholesale rejection. For example, maybe the company didn't properly account for one specific lease agreement, or the auditor couldn't verify the inventory at one small, remote location. The rest of the statements are still considered reliable, but that specific issue is carved out. Okay, next up is the adverse opinion. This one is much more severe. Thankfully, it's pretty rare because it usually signals really serious financial reporting problems. An adverse opinion states unequivocally that the financial statements do not present fairly the financial position, results of operations, or cash flows in conformity with the framework. Full stop.
Do not present fairly. That sounds bad, really bad.
It's the worst opinion you can get regarding the statements themselves. The implication is dire. The problems the auditor found are so significant, so widespread, so fundamentally misleading that the financial statements as a whole cannot be relied upon, period. This opinion is used when the auditor identifies misstatements that are not only material but also pervasive. The financial statements are fundamentally flawed and basically misrepresent the company's financial reality. You should view any financials with an adverse opinion as inherently untrustworthy.
So this is the do not buy stamp. The entire car is fundamentally flawed, and maybe the engine's shot, the brakes are gone, the frame's bent. It's way beyond fixing a single headlight. The whole thing is a hazard, unusable, a total rejection of the financial statements.
Precisely. It's the strongest negative signal an auditor can give about the statements themselves. It often leads to severe consequences: stock delisting, loss of investor confidence, banks running away, potential regulatory action. Things like systemic fraud or a complete disregard for accounting principles could lead to this. Okay, the third type of modified opinion is the disclaimer of opinion. This one is unique. It states that the auditor does not express an opinion on the financial statements.
Doesn't express an opinion, so they're not saying it's good or bad.
Exactly. They're saying they can't say. This isn't a statement that the financial statements are necessarily wrong, but rather that the auditor was unable to gather enough sufficient appropriate audit evidence to form any opinion at all. The implication is the auditor just couldn't complete their work satisfactorily. Usually this is due to a significant scope limitation. Maybe management flat out refused access to critical records, or maybe, like we said, a disaster destroyed everything. This inability to get evidence is so significant that its potential effects are considered material and pervasive. The auditor simply lacks the basis to attest to anything about the fairness of the statements because they couldn't get the necessary information. It signals an extreme lack of assurance.
So this is the I can't even tell you if the car works because the hood is welded shut, or maybe the engine's missing entirely, or it's buried under 10 feet of snow. There's simply not enough information to form any judgment. The auditor essentially throws up their hands, not because the statements are proving wrong, but because they couldn't do their job thoroughly enough to say either way. It's an information vacuum.
That's a perfect way to put it, an information vacuum. It signals an extreme level of uncertainty. Now, there's a crucial rule that links these two most severe opinions, adverse and disclaimer, together. It's sometimes called the passkey rule, and it's all about preventing contradictory messages. The rule says, when an auditor issues an adverse opinion or disclaimer of opinion on the complete set of financial statements, remember, balance sheet, income statement, cash flow, equity, notes, they cannot then turn around and issue an unmodified, clean opinion on just a single one of those statements, like, say, just the cash flow statement looks okay, or on one or more specific accounts within a statement.
Okay, hold on. So if the whole picture is deemed fundamentally misleading, adverse, or impossible to verify, or disclaimer, you can't then say, oh, but this one little piece over here looks fine.
Exactly. Prevents companies or auditors from trying to cherry pick something positive when the overall message is deeply negative or completely uncertain.
That makes sense. It prevents contradictory messages. If the overall car is condemned or completely uninspectable, you can't logically certify that the tires are perfect because the context makes that irrelevant or unverifiable too, right? They're all interconnected.
Precisely. Issuing a clean opinion on just the cash flow statement when the overall statements received an adverse opinion would directly contradict the main conclusion. It would create huge confusion for users, maybe falsely implying that some part of the financial information is reliable when the auditor has explicitly stated the whole picture is misleading or unverifiable. This rule ensures the message is consistent, clear, and unambiguous about the lack of reliability of the company's financial reporting as a whole. It's a critical safeguard.
Okay, so we've mentioned this word pervasive quite a few times now. You said it's the key, the real game changer, in understanding why an opinion escalates from qualified that except for opinion to the much more serious adverse or disclaimer. It determines the severity. What exactly does pervasive mean in audit terms? How do auditors actually judge if something is pervasive?
That's a critical question. Understanding pervasiveness is arguably the most important qualitative factor distinguishing between a qualified opinion and the more severe adverse or disclaimer. Pervasive effects on the financial statements are those effects which, in the auditor's professional judgment, are so widespread or so fundamental that they affect the financial statements comprehensively. It's about the magnitude and the reach of the misstatement, or the scope limitation. Does it impact the very usability and reliability of the financial statements taken as a whole? The auditing standards give us three key criteria to help define pervasiveness. Auditors apply their judgment using these. First, effects are considered pervasive if they are not confined to specific elements, accounts, or items of the financial statements.
Meaning the problem isn't isolated, it spreads out.
Exactly. It affects multiple parts of the financials, making it hard to just carve out or quantify its total impact. For instance, if a company's whole internal control system over financial reporting is completely broken, leading to potential errors in how they record revenue and expenses and value assets, that sounds pretty pervasive because the effects aren't neatly contained in one box. It's more like a systemic failure.
Like a computer virus spreading through the whole network, not just affecting one file.
Good analogy. Second, even if the effects are confined to specific elements or accounts, they're still considered pervasive if they represent a substantial proportion of the financial statements.
So even if it's just one thing, if that one thing is huge, it's still pervasive.
Precisely. Imagine a company whose main business is, say, developing one single piece of software, and that software is basically their only significant asset. If there's a material misstatement about the value or ownership of that one asset, even though the problem is confined to that asset account, if it represents, say, 80% or 90% of the company's total assets, that misstatement is undeniably pervasive. It fundamentally distorts the entire balance sheet, making it unreliable. It's one piece, but it's the critical piece.
Okay, so either it affects lots of things or it affects one really, really big thing. What's the third criteria?
The third way something can be pervasive is if it relates to disclosures that are fundamental to the user's understanding of the financial statements. This one highlights just how critical those notes, the fine print, really are. If a company fails to disclose something absolutely essential for users to interpret the numbers correctly, maybe it fails to disclose that there's substantial doubt about its ability to continue as a going concern when it's clearly circling the drain, or it omits information about massive, potentially bankrupting legal contingencies. That omission of disclosure can be pervasive.
Even if the numbers in the main statements add up correctly.
Yes. Even if the numbers themselves look okay on the surface, the lack of this fundamental disclosure means users cannot truly understand the company's real financial position, its future prospects, or the massive risks it faces. It makes the entire set of statements misleading and unusable for making informed decisions. The missing fine print here is so vital that its absence breaks the whole narrative.
Wow, those examples really clarify it. Pervasive means it's not just a contained problem. It either affects everything, or it affects something so big it might as well be everything, or it's a missing piece of information so crucial that you can't understand anything properly without it. It really is the game changer. So, pulling all this together now, how does an auditor use materiality and this critical concept of pervasiveness to decide which opinion to issue? Can we maybe visualize this as a kind of decision matrix?
Absolutely. This decision matrix is often where it all clicks for people. It clearly links the nature of the problem. Is it a misstatement in the financials? Or an inability to get evidence? And its severity? Is it material? Is it pervasive? Directly to the type of audit opinion. It's the framework for their judgment, and understanding it empowers you, the listener, to quickly interpret what an opinion really means. Let's break it down. We have two dimensions: the nature of the issue, financial statement issue versus audit issue scope limitation, and the level of severity. Immaterial, material but not pervasive, material and pervasive. Okay, first row. If the issue is none or immaterial, doesn't matter if it's a tiny error in the statements or a minor limitation in scope, the outcome is the same. Unmodified or unqualified opinion. Clean bill of health. No problem big enough to worry about. Second row. If the problem is material but not pervasive, if it's a financial statement issue, a material misstatement, but it's isolated, like our broken headlight example, the auditor issues a qualified opinion, except for
Okay, mostly fair, but with a specific known flaw.
if it's an audit issue. The auditor couldn't get evidence for material area, but the limitation is isolated, like not being able to check inventory at one remote site. The auditor also issues a qualified opinion, except for the possible effects of the item they couldn't verify.
Okay, so material but not pervasive always leads to a qualified opinion, regardless of why there's an issue.
That's right, for the qualified level. Now, the crucial third row. If the problem is material and pervasive, this is where the reason matters. If it's a financial statement issue, the statements themselves are fundamentally and widely wrong, like our do not buy car example. The auditor issues an adverse opinion. The statements are deemed entirely misleading.
Material plus pervasive misstatement equals adverse. Got it.
But if it's an audit issue, the inability to get evidence is so severe and widespread that the auditor can't form any opinion, like our can't open the hood car. The auditor issues a disclaimer of opinion. They just can't provide any assurance.
Material plus pervasive lack of evidence. Disclaimer. That matrix makes it crystal clear. So if our listeners remember nothing else from this deep dive, remember that matrix, and especially the critical role of pervasive. That's the dividing line. It's the difference between a specific manageable caution, qualified, and either a complete rejection of the financial statements, adverse, or a total inability to evaluate them, disclaimer. It clarifies exactly why an issue leads to one opinion versus another.
Absolutely. And if we connect this back to the bigger picture, understanding this matrix really empowers you. When you see an audit report, you can quickly interpret the severity and the nature of any issues the auditor found. It gives you truly critical insights into a company's financial health, its transparency, maybe even its management integrity. It helps you differentiate between a minor hiccup and a fundamental flaw, or perhaps an opaque situation where there's just not enough information, which itself is a major red flag. This is a powerful tool for making informed decisions as an investor, a lender, a partner, whatever your role.
What an incredible deep dive. Seriously, we've journeyed through this really intricate world of audit opinions, right from their basic purpose all the way to the precise judgments involved in issuing them. So just to quickly summarize the highlights, we've covered the four main types. There's the unmodified opinion, that's the clean bill of health everyone wants. Then the qualified opinion, think of it as specific warning. Everything's okay except for this one material but not pervasive issue. Then the adverse opinion, that's the most severe negative judgment on the statements, meaning they're materially and pervasively misstated, basically untrustworthy. And finally, the disclaimer of opinion, where the auditor says, I couldn't get enough evidence to form any opinion, usually due to pervasive scope limitations.
And throughout this, hopefully, we've highlighted the critical, very nuanced role the auditor plays in trying to ensure financial statement reliability. Their work, guided by rigorous standards like GAS and accounting frameworks like GAAP, aims to provide that independent, reasoned judgment. And as we saw, understanding those concepts of materiality is the error big enough to matter, and especially pervasiveness is the problem widespread or fundamental. It's absolutely key. These concepts are the bedrock for interpreting audit opinions effectively and really discerning the true financial health of an organization.
Absolutely. I think what this deep dive really showed is that an audit opinion is so much more than just a simple pass-fail grade. It's this deeply nuanced communication, right? A detailed summary from an independent expert that provides this crucial layer of trust and transparency or lack thereof to financial reporting. It speaks volumes about the quality, the reliability of a company's financial story, and maybe even its overall integrity. So now that you've got this deep dive under your belt, the next time you find yourself looking at a company's annual report, don't just skip past that auditor's report section. Take a moment, see which opinion they've actually issued, and then ask yourself, what does this particular opinion, unmodified, qualified, adverse, disclaimer, what does it really tell me about the underlying financial health and transparency of this organization beyond just the raw numbers themselves? Is it a clean bill, a specific caution light, or a blaring siren that demands a lot more investigation?
Yeah, and that raises a really important follow-up question for you to think about. How might the absence of an audit opinion altogether, or seeing one of those modified opinions, especially an adverse or a disclaimer, how might that influence critical investment decisions or public trust, even if maybe some of the headline numbers the company is touting initially appear positive? What other information would you, as an informed user, immediately want to seek out if you saw anything other than a clean, unmodified opinion? Would you start digging for alternative sources? Would you worry about the company's ability to raise money or attract business partners? These opinions have real consequences.
Those are really powerful questions to mull over as you go forward, applying your newfound insights into the world of audit opinions. Thank you so much for joining us on this deep dive. We genuinely hope you feel more confident and equipped to dissect financial reports, now with a sharper, more informed lens. Keep exploring, keep questioning, and we'll see you next time.